Hello everyone, welcome to PwC Tax Bite podcast series. I'm of course still Peter, but I'm very happy to introduce to you a colleague who recently joined PwC, Joris Lutz, because I want to talk about the European Tax Omnibus proposal. This important proposal for Europe was published, I must say leaked maybe, recently, and there are a number of very important proposals included in there. So together with Joris, I want to explore what's actually on the table, what's in the proposal, and what can be the impact for European businesses. But before we start the discussion, Joris, you are a bit a new voice, new face to the podcast, so maybe a good idea that you can say a bit about yourself to the audience.
Yes, thank you, Peter, and thanks for inviting me to this podcast. As Peter mentioned, I recently joined PwC. I will be taking up a number of functions, including following up on recent developments, which I have done also in my previous career, and I focused on and will still focus on international European tax, including state aid matters as well as Belgian corporate tax.
Well, thanks, Joris. I think you are the right person to have in this podcast on the Tax Omnibus. Maybe before we dive into details, all I've heard about from a European perspective in the past years was introduction of anti-abuse rules, anti-tax avoidance measures, new publication formalities, etc. So all of a sudden we hear about a tax omnibus that would, if I hear correctly, simplify life for taxpayers in Europe. Has there been a mentality change all of a sudden in the European Union?
Well, you could say that this proposal, or as you said, the leaked proposal for directive, ties in with previous reports which were published at the EU level. For instance, the Draghi report, which stressed the importance as well in the present times, but also in future years, of the competitiveness of the EU. And this is actually a translation of that competitiveness objective at the EU direct tax level. The EU tax legislator also wants to simplify, declutter, and reduce compliance burdens for businesses. And that is actually the context of this upcoming proposal for directive.
Okay. Can you say a bit more? What is the tax omnibus? Why is it potentially relevant? What is the aim of the omnibus and the scope?
Yes, the tax omnibus is actually a directive or a proposal for directive that would amend in one go 6 EU direct tax directives that are currently in existence. Just listing these directives, it includes amendments in respect of the Interest and Royalties Directive, the Parent-Subsidiary Directive, the Tax Merger Directive, also importantly the Anti-Tax Avoidance Directive, but aside from that also to the Dispute Resolution Mechanisms Directive and the FASTER Directive. All of these directives would be amended in one go, or at least that is currently that will be put on the table. And these changes are intended, as I said, to reduce the compliance cost for businesses in the EU, simplify the EU direct tax framework, and in the end strengthen the competitiveness of the internal market and the EU as a whole. And this would, according to projections of the European Commission, amount to an annual compliance cost saving of approximately 7 billion euro.
Okay, Joris, that's an ambitious targeted simplification in Europe. Let's go a bit in the details, and suggest we put it a bit in different blocks. Maybe we can start with the Interest and Royalties Directive, Parent-Subsidiary Directive, and the FASTER Directive. So 3 out of 6 all have to do with withholding tax, I think. Can you elaborate a bit for the audience what's actually in the proposal for these directives?
For surely. In the Interest and Royalties Directive, as it currently stands, there is a withholding tax exemption on interest and royalties, but it requires that a minimum holding requirement is met for that source taxation exemption to apply. And in the proposal that is currently circulating, this minimum holding requirement would actually be abolished, so that effectively all interest and royalty payments within the EU would be free of withholding tax, irrespective of the holding between the companies involved, which is a very welcome development. On the flip side, this exemption, this broader exemption, would be coupled with a new double non-taxation mechanism, a mechanism to avoid double non-taxation from arising. Stating that if the interest or royalty would be paid to a recipient who does not pay income tax on that interest or royalty, then the member state of source should either apply withholding tax at source or deny the deduction of the corresponding cost. So that is intended to avoid double non-taxation from arising and ensure that the interest or royalty is subject to tax once. That are the changes at a substantive level, I would say, of the Interest and Royalties Directive. From a more procedural perspective, the Interest and Royalty Directive would be amended to provide that prior authorization or certification procedures that would apply and that are currently allowed under the directive to apply to avoid withholding tax at source, that these procedures can no longer be in place. These procedures should be abolished. Instead, it would be up to the distributing, the payor of the interest and royalties to self-assess whether the conditions for the withholding tax exemption are met. Of course, the member state of source can still apply anti-abuse rules, including a beneficial ownership test. In the case that the payor of interest and royalties would not be in a position to determine that the conditions of for the withholding tax exemption to apply, that these conditions are met, and is then compelled to apply withholding tax at source. The proposal for directive provides that a refund mechanism should apply, either for listed securities, the FASTER, the refund mechanisms provided for in the FASTER Directive would need to apply, or outside of these situations, domestic procedural rules should apply, but the refund should be granted within a reasonable time. Finally, and then I will move to the other directive, which are quite similar. The annex of the Interest and Royalties Directive, which includes the list of qualifying company forms, would be updated, and the Commission would also be granted powers to update this list as new company law forms are adopted in the member states. Turning to the Parent-Subsidiary Directive, the changes there that are being proposed in this upcoming proposal are relatively similar. Also for the Parent-Subsidiary Directive to apply the withholding tax exemption on the one hand and the participation exemption on the other hand. In the current directive, there is a minimum participation requirement of 10%. That participation requirement would be abolished as well, so that dividend distributions within the EU would also be exempt and would only be subject to taxation once, namely the corporate tax at the level of the subsidiary. There are some other changes. In the current directive, it is currently provided that the charges and losses that are related to the holding can be denied. The tax deductibility thereof can be denied. This rule is maintained in the proposal for directive, but is limited to participations of 10% or more. Another important change in respect of the Parent-Subsidiary Directive is that pension institutions would be exempt from withholding tax. So the scope of the withholding tax exemption of the Parent-Subsidiary Directive would be extended to pension institutions irrespective of their legal form, and this would apply in derogation of the common subject to tax condition, which is included in the Parent-Subsidiary Directive. Those are I would say, the substantive changes that are being proposed. Procedurally, I can be quite short. The changes there that are being proposed to the Parent-Subsidiary Directive are similar, if not identical, to those that are being proposed in respect of the Interest and Royalties Directive. So no prior authorization or certification procedures at source to apply the withholding tax exemption. So a self-assessment of the distributor of dividends. And if need be, a two-track refund mechanism, either the FASTER mechanism for listed securities or the common domestic procedures within a reasonable time for other cases. And just to be complete, the FASTER Directive, this directive would also be amended just to provide that these refund mechanisms that are being provided in the Interest and Royalties Directive and Parent-Subsidiary Directive would effectively occur via the FASTER mechanism.
Okay, thanks. That's an ambitious idea. No more withholding tax within the European Union, irrespective of the level of the participation. Simpler procedures. Looks very promising. You also mentioned the Tax Merger Directive as another proposed directive for change. What exactly will change to the Merger Directive?
Well, also the changes there are quite interesting. A few years ago, the company law directive that governs cross-border restructurings and reorganizations was also amended, and it was felt that the Tax Merger Directive should be aligned to cover also the new restructuring forms that are provided in the so-called corporate law mobility directive. So the scope of the Tax Merger Directive would be extended to cover, on the one hand, simplified mergers, which are mergers between sister companies, so side stream mergers that are being conducted without the issuance of new shares. And also the so-called division by separation would be covered in the Tax Merger Directive as well. And this is a demerger where the shares are not being allocated to the shareholders of the partially demerged company, but to the partially demerged company itself. Those types of restructurings would also be granted the tax neutral treatment of the Tax Merger Directive. On the other hand, a new chapter would be introduced in the Tax Merger Directive, which covers cross-border conversions of legal form. In the current Tax Merger Directive, it is only possible for the European company, the SE, or the European cooperative company, the SCE, to transfer its seat in a tax-neutral way. This is in fact extended now to, or it is being proposed that it would be extended to a cross-border conversion of any company. Any company can then change its corporate form of one member state into the corporate form of another member state. And to be a cross-border conversion that is in scope, the company should at least transfer its registered office as well to the member state of entry. And this should, of course, and that is provided, also happen in so-called legal continuity. So the legal personality of the company should not be lost somewhere along the way. In these types of cross-border conversions that are in scope, a tax neutrality regime would apply both at the level of the company, at least insofar as there is no loss of taxing rights for the member state of exit, and a tax neutrality regime would also apply at a shareholder level. Similar to the Parent-Subsidiary Directive and Interest and Royalties Directive, I would say the annex to the Tax Merger Directive of the qualifying company forms would be updated as well. And also there, the powers are granted, or would be granted to the Commission to provide further updates of this list going forward.
Okay. Thank you. Also, in respect of tax disputes, some changes would be considered. What exactly would happen in that space, Joris?
Well, these changes to the so-called Tax Dispute Resolution Mechanisms Directive, that these are directed at several issues that are that were identified in practice. For instance, multi-entity disputes. Disputes where the taxation of multiple member states concern not a single taxpayer but more taxpayers at the same time. Some clarifications are provided in the directive, or would be provided in the directive, to cover this situation. For instance, the definition of affected person would be amended so as to cover these multi-entity disputes, and it would also be provided for these multi-entity disputes which taxpayer should launch the complaint to which competent authority. On the other hand, a current requirement is the simultaneous submission of a complaint to the competent authorities of the member states involved. This in practice gave rise to several discussions, and this simultaneous submission requirement would be replaced by a 30-day filing window. In addition to that, there are several amendments that are intended to open up or to facilitate access of taxpayers to the dispute resolution mechanisms directives procedures. For instance, when the competent authorities immediately recognize that there is no mutual agreement possible, they should no longer wait, or they can no longer wait until the expiry of the 2-year MAP period, but should immediately notify the taxpayer involved so that an earlier arbitration would be possible. And aside from that, in the current directive, it is provided that parallel proceedings in respect of the dispute, that these are terminated. In the new proposals that are circulating, it is provided that these parallel proceedings are only suspended when filing this the complaint under the directive, and would only be terminated once a mutual agreement procedure is completed, and a solution effectively exists for the taxpayer. I think those, there are some other changes, but those are the main ones, I would say, in respect of the Dispute Resolution Mechanisms Directive.
Yeah, thanks, Joris, for that clear overview. I would say last but not least is the Anti-Tax Avoidance Directive. So this is an important directive for a lot of companies in the audience. The interest limitation rule is part of that, and etc. What is the proposal of the Commission for the ATAT directive, Joris?
Well, those proposals are are twofold, I would say. On the one hand, you have several amendments to the existing anti-avoidance rules that are included in the Anti-Tax Avoidance Directive. On the other hand, the Anti-Tax Avoidance Directive would be amended to include also a rule which is beneficial to taxpayers, namely an EU-wide R&D allowance. So aside from the anti-avoidance rules, the directive would would compel the member states to allow for a full and immediate deduction of capex, capex related to R&D, and this would give rise to a tax deduction in the year in which this capex is incurred, or in the 4 subsequent tax periods. There are some anti-avoidance rules that apply, and important to stress, this EU-wide R&D allowance is only a minimum standard, so member states can apply more favorable regimes. That is a positive rule being included in the Anti-Tax Avoidance Directive. As I said, some other anti-avoidance directives, other anti-avoidance rules that are currently already included are being amended. First of all, the interest limitation rule is amended. I will just briefly highlight, because the changes there are quite numerous, but briefly highlight what those changes are. For instance, the EBITDA cap, which is set at 30%, is now not fixed, so that member states can apply a more strict standard, for instance, 20% of EBITDA. Going forward, this 30% limit would be fixed and mandatory EU-wide, so member states cannot go above or below the 30% EBITDA threshold. In addition, the 3 million safe harbor rule, which is currently included in the directive, an optional rule, would become mandatory going forward and would be increased to 5 million euro. In addition, some other important proposals there. The Commission identified that third-party loans are not necessarily abusive, so it proposes to include an exclusion for so-called low-risk third-party loans, where the financing is granted by a real third party, and the loans are used for the own activities of the taxpayer. This is quite strict, but okay. In addition, the group escape rules, which are also currently included in the Anti-Tax Avoidance Directive, but as an optional rule, would become mandatory, so that taxpayers can deduct a higher amount of exceeding borrowing costs if this is in line with the leverage level at group level. And there would also, for instance, be a safeguard in economic downturn, in times of financial stress. The EBITDA rule would not apply if the EBITDA of the taxpayer drops in a given year by more than 50%. Then there are some other clarifications and exclusions in terms of long-term public infrastructure projects, the financial undertakings exclusion, but I think it would go beyond the scope of this podcast to delve into that in great detail. Finally, there would also be a temporary defense sector exclusion, so loans that are allocated to specific types of defense sector investments would also be temporarily excluded. Those are the changes, I think, in respect of the interest limitation rule. Then briefly, the CFC rule also being proposed that it is amended. On the one hand, taxpayers subject to Pillar 2 would would be exempt from the CFC rule going forward, with certain exceptions. A new exemption would be included for SMEs, and the Model B rules. As you know, the CFC rule currently in the Anti-Tax Avoidance Directive provides for two types of mechanisms, two models. Model B, which is more of a transfer pricing approach to CFC, and Model A, which is a list of passive income elements. This Model B, so the transfer pricing approach, would be deleted, and Model A would become mandatory. Finally, the CFC rule provides in its current form an optional de minimis rule of where one looks at the passive income and a threshold of 1 to 3. This de minimis rule would become mandatory going forward as well. Just to make sure that we are complete. The Anti-Tax Avoidance Directive also includes a general anti-avoidance rule and hybrid mismatches rule. The changes there are not revolutionary, I would say, but the general anti-avoidance rule would be amended to clarify that it also applies to withholding taxes and Pillar 2 top-up taxes, and also a welcome development, I would say. The hybrid mismatches rule would also be simplified in the sense that the so-called imported mismatch rule would be deleted altogether. I think that is in a nutshell what is currently on the table in terms of amendments that are being proposed to the Anti-Tax Avoidance Directive.
Yeah, thanks, Joris, for that overview. An ambitious package of measures, that's clear. Changes to the ATAT, changes to the withholding taxes within Europe. I think for a lot of companies in the audience, very important measures. Now, my question is, how does the next step look like? How will this be approved? We're talking about a leaked version published ahead of the official date. How does the approval process look like, and when can companies start to expect, hopefully, the positive impact of this proposal?
Indeed, it is a leaked proposal, and its official publication will only occur later this month, the 25th or the 24th of June, actually. And we will have to wait and see whether the actual proposal matches the content of the leaked version. But I would say that the chances are great that this will be the case. Once the proposal is published, then it is the discussions will start in the Council because this directive is subject to the unanimity requirement. So all member states would need to agree upon the adoption of this directive. And given that this directive may cause certain budgetary hits for certain member states, it is not clear whether this unanimity would be able to one would be able to reach this unanimity. The entry into force of the directive, so the transposition of this directive is still not clear. It is not yet fixed in the version that was leaked, and certain changes that are being proposed will only enter into force a couple of years after the entry into force of the directive itself, so after the transposition date of the directive has lapsed. So the beneficial impact to businesses may only be appear in the future.
Okay, thank you, Joris, for clarifying that as well. It's very important, of course. Yeah, we're starting to reach the end of the podcast, I think, which gave a good overview of the new Tax Omnibus proposal. Maybe before we disconnect, what would be your recommendation for the audience, having heard about all these potential measures and reflecting on the impact? What would you recommend people to do?
Well, this is only a leaked version, and we'll have to wait and see whether this actually matches the actual proposal. In a few weeks, we will it will become clear whether that is the case. But if certain of these measures are important to you as a business, as a company, I think it is important to raise your voice. Certain member states will, for instance, not be inclined to adopt, but if a critical mass of companies, businesses voice their support, this may actually stimulate the adoption of the directive. I think that is the main message, I would say.
Yeah, yeah. Thank you for that, and thank you for joining your first Tax Bite podcast, Joris. With that, I would also like to thank the audience for tuning in, and we'll definitely be connecting with you if further developments happen on this and other European developments. Thank you. Have a great day.